This video, I want to talk about how market capitalization shapes stock selection and portfolio strategy. How does considering the different market caps in your portfolio, how does it really shape your portfolio strategy? I want to talk about this particular topic, by considering the different aspects of the content one by one. Number one is understanding market capitalization. Understanding market capitalization. So what is the definition of market cap? Market capitalization is the total number of value of a company's outstanding shares calculated, by multiplying, these shares outstanding by the current market price, stock market price of the company. That's the market price times the shares outstanding will give you market capitalization. And when you talk of categories, stocks are divided into small caps. That's under $2 billion. You have a mid cap between $2 to $10 billion, and you have large caps above $10 billion. Number two is stock selection based on market cap. So in this case, you consider small cap stocks. These are typically high growth but higher risk investments, ideal for aggressive investors looking for higher returns. If you have the risk appetite and you're looking for higher returns, this particular category is for you. You talk about mid-cap stocks. Mid-cap stocks offers a balance of growth and stability, suitable for investors seeking moderate risk with strong growth potentials. You also consider large cap stocks. So large cap stocks offers a kind of balance of growth and stability, suitable for investors seeking moderate risk and strong portfolio growth, strong growth potentials in their portfolio. Number three is portfolio construction using market capitalization. How do you construct your portfolio? How do you craft your portfolio with market capitalization in mind? So in this case, you consider risk management. When it comes to risk management, market cap is a key tool for managing risk. Small cap stocks offer higher growth potential, but they do that, at a higher risk level. While large caps are more stable, mid-cap stocks, serve as a balance between the high volatility of small cap and the stability of large caps stocks. Equally consider diversification. So these include a mix of small, mid, and large cap stocks, and it tends to deliver, it tends to diversify your portfolio, kind of reducing the overall risk of spreading investments across different company sizes and market segments. So you diversify across market capitalization. So you also take into consideration strategic allocation. When it comes to this kind of strategy, you inculcate, what is called strategic allocation. In this case, you may consider aggressive growth portfolio. An aggressive growth portfolio have a higher allocation to small and mid-cap stocks, preferably between 40 and 60% of the stocks are small and mid-cap companies. This constitutes a typical aggressive growth portfolio. You want to talk about balanced portfolio. In the case of balanced portfolio, there's a mix of large cap, which constitute 40 to 60% of the portfolio, and mid cap, which constitute 20 to 40% of the portfolio, as well as a small cap, which makes up 10 to 20% of the portfolio for a kind of diversified growth. Then you have the conservative portfolio. When we talk about the conservative portfolio, we are highlighting heavier weights, in large cap stocks. That is 60 to 80%, with a smaller portion, in mid cap stocks, in mid cap and small, cap stocks. That's 10 to 30%. All right, 60 to 80% in large cap stocks, and then 10 to 30% in mid and small cap stocks. That constitutes a conservative portfolio. Number 4 is performance and volatility. Performance and volatility. In this regards, you want to look at small cap stocks. Small cap stocks are more volatile, but can deliver higher returns, especially in a growing sector or in a growing industry. We equally look into mid-cap stocks. Mid-cap stocks tend to be more resilient during market fluctuation than small-cap stocks, and they have a moderate potentials for growth. Lower risk, less volatile, but with a smaller or a moderate potential for growth. Then we take into consideration large cap stocks. And large cap stocks are kind of more stable and they are less volatile, often performing well during economic slowdown, but offering slower growth. The growth potential is relatively small, but they are more stable. They offer acceptable performance in times of economic slowdown. Then number 5, before then, please you subscribe to this channel and like this video. It will do me a ton of good. Number 5 is aligning market cap with investment goals. How do you align your market capitalization with investment goals? You have these growth-oriented goals. Growth-oriented goals. So small and mid-cap stocks, are preferred for higher growth strategies. If your aim is to grow your portfolio at a higher pace, then you should consider small and mid-cap companies. Let them constitute a larger percentage of your portfolio. Then if you are kind of income-oriented investor, income-oriented goals, you want to have steady income coming in, then you go for large cap stocks with dividend payouts, and there's that consistent income as a result. Large cap stocks that pays dividends regularly. Then if you prefer a balance, balanced growth and stability, you want to balance both growth and stability, then this should encourage you to kind of adopt a mix of market caps, allowing you to achieve a balance between growth potential and stability, optimizing returns while also managing risk. You consider growth, you also consider stability. All right. Growth from small and mid cap stocks and stability from large cap stocks. Then number 6, adjusting over time. So as a matter of as a market condition changes, you should adjust your allocation to keep abreast of changes in market conditions. So rebalancing your portfolio based on market cap helps ensures that it aligns with your evolving risk tolerance as well as your investment horizon. And so market capitalization plays a pivotal role in stock selection and portfolio construction, guiding investors in choosing the right balance of risk, growth, and stability as well as the ability to meet uh, your financial goals.